Hi folks, hopefully you are well. Now today I want to talk to you about what I think is one of the biggest problems that most face when they come into the markets for the first time. The Forex market is basically a two-dimensional market. So when you're buying a Forex pair, you're basically buying one currency and selling another currency. That's basically why they're called pairs. We basically pair up two different economies, two different currencies. And our job as traders is to predict the future in terms of which currency is going to outperform another currency. Think of all the different countries in the world, each with their own individual currencies. You can see straight away that the opportunities, the different options that you can have to trade are absolutely vast. So the big question is, what should you be trading? Well, from the get-go, I would say this: the fewer, the better. How's that expression go? Jack of all trades, master of none. When you're starting off in trading, I think you should be trading just a very few different number of pairs. And the reason being is, I think, is if you can't make money on just a handful of currency pairs, opening up to trading hundreds of different currency pairs won't make you a trader. Now, the main 8 currencies that we focus on in the currency markets are basically the US dollar, the euro, the British pound, the Japanese yen, the Swiss franc. Then you've got the commodity currencies, the Australian dollar, the New Zealand dollar, and the Canadian dollar. Now, when you cross-match all those 8 different currencies, there are basically 28 different opportunities, 28 different currency pairs that you can trade. Now, just before I came on camera, I went to the Bank of International Settlements. It's widely considered to be the authority in terms of volumes that are going through the various markets. And I went to the Forex section. And on here, you'll see it on the screen now. Basically, the US dollar accounts for 88% of all foreign exchange transactions of the $6.1 trillion market on a daily basis. That's followed by the euro, which is down there at 31%. And then the Japanese yen is 22%, and then the pound 13%, and then it pales into reasonably insignificant volume going through in the other currencies. So you can see just by this data alone, the most actively traded currency pair is the euro against the US dollar. Then you've obviously got the Japanese yen and pound in there as well. So I think what's important when deciding what currency pairs to trade is to look at 3 important factors. First of all, you should be looking at the opportunity. Then you should be looking at the cost. And then I think you should also be looking at the risk. And we'll just go through those now. So let's first start off by looking at the opportunity. So you can see there from the data that I've just shown you that the most actively traded currency pair on the planet is the euro against the US dollar. That's with all the retail, all the big banks, all the big FX hedge fund traders as well. The euro against the US dollar is the biggest market. Now, often when we're trading the Forex market, we look for support and resistance. We look at trend lines, we look at moving averages and so forth. But these levels of support and resistance, if there's more players playing at those levels, the opportunities there could be much more well respected than maybe the exotics where there's not so many market participants. So think about that. If you're looking at trading those type of levels, or you're looking at trend lines and so forth, the euro dollar has many, many more opportunities for the rookie trader, in my opinion. Okay, next up, let's talk about the cost. Now, as with any market, there's an associated cost when trading. Now, most obvious cost, of course, is what the broker charges you to place the buy order and the sell order. But often the hidden cost of trading is known as the spread. Now, the spread is the difference between the buying price and the selling price, and it can be quite significant, and it does vary a lot between the different currency pairs that you may wish to trade, and it becomes much more important as well depending on how many times a day that you are trading. If, for example, you're scalping, that basically means you're in and out of the markets multiple times a day, this spread can be very, very important. Now, the euro against the US dollar, as we've determined, is the most actively traded currency pair on the planet. It has the most liquidity, the most players in the market. Therefore, the spread between the buying price and the selling price can be really, really tight. In fact, I've seen many brokers out there, depending on the liquidity that they're offering, ECN or raw spreads, the spread can be zero, nothing, no difference between the buying price and the selling price, so basically no cost of trading. Whereas other currency pairs may have quite a wide spread. If you're trading the Swiss against the New Zealand dollar, for example, that spread can be pretty wide, and that's just a minor. Think about going out to the exotics, the spread can be quite prohibitive, depending, of course, on the strategies and the time frames that you are trading. So the spread, the cost of trading, the euro dollar or the most actively traded currency pairs is a lot less. And lastly, let's talk about risk. There are different risk profiles depending on the different currency pairs that you are trading, and not least of all because of the spread. Think about this for a moment. When you're placing a trade in the markets, as we always recommend, you have a stop loss in there. Stop loss basically means when the price hits that level, you're stopped out, no more losses, and you're out of the trade. Now, of course, if the spread is really wide, the chances are that you may get stopped out when the price doesn't actually reach your level, because the spread is so wide. So the spread is moving either side of your stop, you get stopped out basically, and the price didn't even actually touch your level. Also think about this. Some pairs have quite low liquidity, and low liquidity basically means the spread widens. As I mentioned, the New Zealand against the Swiss, over some data releases, maybe out of New Zealand, that spread can move out. I've literally seen these spreads move from maybe 3 or 4 pips out to 50 pips. If that happens, chances are, if your stop is pretty close, you are going to get stopped out. So make sure you factor that in as well when you're thinking about which currency pairs to trade. So the risk is less when you're trading the currency pairs with much more liquidity. I mentioned the euro dollar, there are others there as well which we'll talk about. And also think about your profit targets. No point trading if you're not going to take a profit. The spread affects that as well. If you've got your profit target at a certain level, the price is moving to your certain level, you think you're going to be banking a profit. If the spread is really wide, you might not be banking that profit because the spread was too wide. If, on the other hand, you're trading a currency pair with a really tight spread, chances are if the market moves to your level, then you're going to get lifted. You will bank your profits if the market indeed hits your level. So that, again, is a big consideration. Okay, so to summarize, there are basically 3 considerations that you should factor in when deciding which currency pairs to trade. You've basically got the opportunities. More actively traded currency pairs present more opportunities. Then you've got the cost of trading. The tighter the spread, the cheaper the cost. Then you've got the risks as well, which we have just covered. More chance of getting stopped out, sometimes less chance of hitting profit targets. So let's just finish off by talking about what the main drivers are of a particular currency. Well, clearly it's interest rates based on the performance of a particular economy. Now, the 3 main economies, 3 biggest, largest economies on the planet, as you may well know, USA, China, and then you've got the Eurozone. Now, we can't trade the Chinese currency too much, it's pretty much closed. So that's why the euro against the US dollar are the 2 biggest economies that we trade. But there are also opportunities in the other currencies as well. I don't want to rule them out totally. You've got the commodity currencies. Australian dollar, Canadian dollar, New Zealand dollar. These are countries that specialize in raw materials, commodities. So it's always worth having that maybe in your armory as well. So pitching these 2 majors, the euro and the US dollar, against the commodity currencies may also be worthwhile. So for example, if you do want to trade more than just one currency pair, maybe you might want to look at, say, the euro against the Australian dollar. Or maybe you might want to look at the US dollar against the Canadian dollar. And maybe you want to throw a pound in there as well. The pound against the Japanese yen, the top 2 behind the US dollar and the euro, maybe it's worth putting them in your portfolio as well. So really the choice, of course, is yours. But I will say this, I think the less the better. Rather than getting confused with all that noise out there, if you can focus just on a few currency pairs to start with, if you can make your money in there, then maybe expand out to the others. One thing is for sure, if you can't make your money in those 4 or 5 or so, then adding more will not make your life any easier whatsoever. And last thing you need to consider is the correlation. The more currency pairs that you are trading, the more susceptible you are to being caught out by correlation. A lot of these currency pairs are correlated. The more you have in your portfolio, the more trades you have open, the more susceptible you are to being caught out when there is a big move, because you could end up losing on multiple positions as well. You've got to know all about correlation and, of course, risk management to make sure that you're not over correlated in any particular direction. And correlations are changing all the time as well, so you need to be on top of that. If you are a rookie trader, you're starting for the first time, I would say keep it to a bare minimum 1, 2, 4 max, I would say. Okay, that's it. Short one this week. Hopefully you found it useful. Give me a thumbs up if you did, thumbs down if you didn't, leave a comment and so forth. Subscribe to the channel, bell notification, you know the YouTube drill. Now, don't forget to follow us on all the socials, of course. And if you want to take part in our daily live streams, we are streaming live every day around the clock, 5 days a week, up to 7 times a day. You can do so over here at forexsignals.com. You can take out a 7-day free trial. If that's not your thing, not a problem. I'll see you next week and have a good week.